Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone. I'm Kavita Baratake, a passive income coach and founder of Cherry Street Investments. I'm excited to have on the call today Adnan Merchant, who's a managing partner and attorney at MW Law. Today, we're going to talk about foreign investing in U.S. real estate. This topic is of particular interest to me because a lot of foreign investors have reached out to me saying, hey, I want to invest into a syndication that we sponsor. And I haven't really been sure on how to structure these investments or bring in these investors, which makes sense. So I thought, hey, why not I learn? And also those foreign investors who are calling in today, hopefully learn a thing or two. Adnan today is going to cover this topic, not just from a syndicator perspective, but also from an investor perspective. So he'll be covering some of the basics that syndicators on this call might know already. But in the interest of having the foreign investors on the call today, we want to make sure we cover all the basics and then also talk about some of the things like the blocker entities which are used, and also some other differences between having U.S. entities or U.S. investors join in a syndication versus foreign investors. So I'm excited to learn today from Adnan, and I hope you guys are as well. A few housekeeping items before we go on to the discussion. Again, we do have an attorney here, but just as a disclaimer, this is always educational. Also, Adnan will be sharing some information about blocker entities today, and you have to understand that this is more a CPA or a tax professional topic. So he'll be mentioning that, but also always consult your own tax professional in these cases. Of course, as far as an attorney, Adnan is an attorney, so he'll be providing great information for us, but always consult your own attorney for your specific setup. Some housekeeping items. Everyone's on mute today, so you can use the chat box to talk to us, or if you have questions, I ask that you type it in the Q&A box, because generally I go through the Q&A box at the end of the discussion. So we'll keep this strictly like a presentation format, and at the end of the discussion, we'll answer all the Q&As that come up. We'll do the Q&A. This webinar will be recorded. I get a lot of questions about this, and we will send out a link within usually 24 to 48 hours max. To avoid it from going to spam, please add my email to your contact list. I get a whole ton of questions about this every webinar, so I'd like to kind of proactively get in front of it. Who am I? I'm the founder of Cherry Street Investments, and I help people invest passively in real estate. I also have an agent license, and I help people find active investments in the Austin MSA. And I have a life insurance license, so I help people set up infinite banking policies. Most importantly, I focus a lot on education, and I appreciate all of you being here today. I know a lot of you guys have joined me before on these webinars, so I appreciate you taking time out to be here today. If you're interested in catching up on our previous webinar recordings, everything's on YouTube. You can look me up on Cherry Street Investor Education. If you'd like to be notified when we upload this webinar, you can go hit the subscribe button, and you'll be notified as soon as this video is uploaded. The recording is uploaded on YouTube. Upcoming webinars, we have one about investing in ATMs with Dave Zook coming up. That will be July 8th. We will talk about residential mortgage and refinancing. That'll be coming up in the third week of July. And I would love some topic suggestions from you guys. Usually the webinars are 2 Thursdays of each month at 7:30 Central, the same time we have today. You can also look me up on Purely Passive Investor Group. It's a Facebook investor group. So if you want to be updated of all our webinars as well as investments, you can look us up there. Just a little bit about me. A lot of you folks know me because there's some new folks on the call today. A quick introduction. I'm from Bangalore, India. Moved here in 1998, graduated with a master's in computer science from Texas A&M. I spent 20 years in technology before I moved to real estate in 2019. Real estate actually helped me become financially free. So it was amazing to start my own business. And I started Cherry Street Investments, and I've been doing these webinars ever since I started my company, literally, and I enjoy doing it. So I'm happy to be here. So a little bit about Adnan today. He is a corporate business and private securities attorney, which means he primarily deals with this topic that we're talking about today, not just from a foreign investor perspective, but from a securities perspective. He started co-found MW Law in 2017, and he's facilitated over 600 million in investment transactions for syndicated and portfolio real estate funds and acquisitions, PE groups, venture capitalists, and the whole 9 yards. Before he started this firm, he served as an in-house counsel to a venture fund where he oversaw a diverse portfolio of investments. He received his JD from Texas Tech and his BA from Austin College. I know he also started like a Austin FinTech or something like that, and I didn't have enough space to include all that. So he's done some awesome things before. In his free time, Adnan enjoys reading and writing science fiction, as well as historical nonfiction genres. That is awesome. I want to figure out your writing, Adnan. That is awesome.
Never.
So do you have any published books?
No, not at all. Not at all.
Not even a self-published
Just for
one
fun.
on Amazon?
Just for fun.
Okay.
No, it's all absolutely terrible because I'm a lawyer, so everything I write sounds like a lawyer. Nobody wants to read that, trust me.
Hey, the fact that you actually write it, it's awesome in itself. I don't think very many of us go into writing something we read, but we might never write. So I know I'm planning to write a book for a very long time. It hasn't happened yet.
Right.
Anyway, he mentors aspiring lawyers. So if you're an aspiring lawyer on the call, you know who to talk to, and embarking on adventures, outdoor adventures with his wife and his dog. With that, I'm going to hand it off to Adnan. Thank you, Adnan. I'll let you share your screen and talk about yourself and also the topic we have today.
Absolutely. Let me get that going. Let me know when y'all can see that. Yep. Okay, can you guys see the screen? I can't tell for sure.
Yes.
Yep. Awesome. Okay. All right. Well, thank you very much for that introduction. You know, I'm honored to be here. Thank you guys for having me on this call. You know, we've connected a number of times before this on various presentations we were both kind of attending and things like that. So it's very nice to be here with Cherry Street Investments with you and to kind of get to talk about all of these things. As you can probably tell, and as Kavita has certainly pointed out, I'm very nerdy about what I do. I love talking about it. And so, you know, this presentation for me really is a lot of fun to be able to give these kinds of talks and kind of get into what we do here, right? So, of course, the same disclaimers, right? Everything that we're doing here is educational. Please consult your own attorneys. We are not investment advisors. We are also not CPAs. We're here to give presentation based on our experiences and the knowledge that we have for what we do. Already had my background, so let's just dive right into it, right? So today we're going to really be talking about three things that I think are super important for anybody who's getting into real estate syndications or who's doing real estate funds and capital and private fundraisers, right? The first is, you know, your typical private equity deal points. So, and again, some of this might be a little bit basic for people who are experienced in these kinds of deals, but I think it's important to kind of go from a broad scope down, especially for those on the call that don't have too much experience with this, right? So what are your typical deal points that you're looking at? And then secondly, what are the typical legal points? So this is where we talk about the investments from non-US persons, how those are typically structured, things like that. And then last but not least, if we get some time, we're going to cover securities compliance, because that is the most important piece that people often get wrong, and that can certainly get you into a lot of trouble if you don't do it right? So the first thing we're going to talk about are some of these basic deal points, right? And by the way, as Kavita mentioned, feel free to please drop questions in. And Kavita, you know, if you see any questions and want to stop me in the middle of the presentation, feel free to do so. I'm happy to make this interactive, or we can do the questions at the end. I leave that up to you.
Yeah, let's do questions at the end. I think it keeps your, you know, the stuff you want to cover on time, and then we'll get to all the questions at once. I think that'll be faster.
Yeah, no problem. So yeah, if you have questions, just drop them in the chat. We'll certainly have time to get to them at the end here. So the first thing that we talk about when we talk about these things, again, like I mentioned, are your deal points, right? So what are those deal points? And what it's going to boil down to, and as you're going to see in these next few slides, Everything that we talk about that is a deal point for a syndication or a real estate, investment deal is about economics versus control, right? The two different sides of the spectrum and where you fall depending on where you are and what you're doing, right? But before we even get into that, when we say private equity, what exactly do we mean when we say that? It's a little bit important to make sure that everyone's on the same page regarding the vernacular and the vocabulary that we're going to be using kind of as we go through this, right? Private equity can mean a number of things. It means a number of different things in a number of different contexts, right? So in this context, when we talk about real estate, passive investing, really all we mean is it's a group of people coming together, pooling capital and sharing risk, right? So it's private capital. It's not public capital, meaning it's not something that you can get by selling these equity securities on a stock market. So you're pooling private capital as investment capital from your groups, your communities, sometimes placement agents or even institutional investors, but basically you're pooling private capital to invest in a deal that is bigger than only one person, right? So that's what we mean generally when we talk about private equity. In real estate specifically, there are two main types of sort of funds, if you will. The first is what we call the syndication. And a syndication is really just a real estate fund, but it's not called a fund because it's a single asset, single project type of deal, right? Where we're going to go buy this multifamily complex, or we're going to go buy this, retail or commercial real estate and hold it for 3 years, 5 years, 7 years, renovate it, maybe do some rehab if we're doing value add, and then sell it. Boom, that's it, we're done, right? The second type is the more traditional fund, which is what we call a private equity or a real estate portfolio fund, right? So it's going to say, hey, we're going to raise, $20 million. We don't know what we're going to do with this $20 million, but in the next 2 to 3 years, we're going to deploy that $20 million in multiple real estate properties, right? We're going to buy a couple of different multifamily complexes. We don't know exactly what yet, but our general thesis is going to be something like this. We're going to deploy it over the next 2 years. And then within 5 to 7 years, those projects should be wound down and everybody's going to get their big chunk and we're going to close the fund and we're done, right? So single project syndication versus ongoing fund to do multiple deals at the same time, right? In both of these cases, right, we come back to the economics versus control. And in all of these deals, your limited partners, those are your investors that you're bringing to the deal. They're usually going to be silent investors, meaning they're going to have limited to no participation rights, right? So they're not going to have any control in the situation, except they're going to get preferential economic rights, right? So as an investor, you're sacrificing control for economics, right? And as a GP, it's the other way around. You're sacrificing a little bit of the pref control, the pref economic rights for that control, right? So as an investor, you're likely going to see something like a preferred return. You're going to get your capital back before the general partner gets to take a share in their cuts, right? The only participation that you might see from time to time is the ability to, of course, remove that general partner with a supermajority vote or whatever it might be, and usually also only for cause, right? If they commit theft, if they commit fraud, et cetera, right? So again, economics versus control. If you're a passive investor, that's what you should be expecting when you come into these deals, is that you're not going to have any sort of real participation or control mechanisms. It's all a passive investment to get returns on your investment, right? So then we talk about that preferred return, right? So what are those preferred economic rights that as an LP, as an investor, a passive investor, you're getting, right? So that's typically what we call the preferred return. Now, what is that? Think of it like interest. It's not really interest because you're not giving a loan, right? It is an investment into a deal. But you're still going to make some sort of an interest on it, and we call that the preferred return, right? Anywhere from 4 to 8%, it's going to be annual, but sometimes it can be compounded or non-compounded. Is it going to be paid out quarterly or monthly or annually? How is it going to be calculated? All of that. All of those minor things are on a deal-by-deal basis. They're specific to the deal. This deal, for instance, might be paying out a 6% preferred return on an annual basis. It's going to be non-compounded. That means it's not going to be compounding interest all the way up, right? It'll be paid out quarterly because it's a cash flowing property, and et cetera, right? So you call that the preferred return because that's your preferred economic interest that you're getting above and beyond the general partner who's putting the deal together, right? All of the LPs are going to get this before the general partner gets other things, right? It's a preferred return. Oftentimes it's called the hurdle, right? But the hurdle to what? What does that mean in the context of calling it a hurdle, right? Well, that's where we get something called the waterfall, which is the distribution priority, right? And this is the most important piece of any fund or any syndication, because at the end of the day, syndications, real estate investments is all about what? It's all about making money, right? So this is the most important piece because this is how the money gets distributed. It's called the distribution priority or the waterfall. And typically, most typically, this is what you'll likely see, right? First, the first dollar that comes into the fund that the syndication or the deal makes as its profit is going to get distributed to all the LPs, all the investors, 100% until they all get their money back, right? So first, we're going to make everybody whole. If I raise $10 million, the first thing I have to do is pay $10 million back to all of my investors, right? Then the second thing is the hurdle that we talked about. Now they get a preferred return, right? So let's say it was a 10% pref for 5 years, and let's say it's been 5 years, right? So I owe my investors that 10% pref for all of those 5 years as the hurdle rate. So the first I have to get that paid as well. So A, I have to give them their money back. B, I have to pay out that preferred return. And then finally, once I cross that hurdle, I get the split, right? I get then as a general partner, 20% of all remaining profits, right? And the other 80% can get pro rata split between all the investors. So that's why we call it a hurdle. And this is also why it can be very lucrative to be a fund manager or a syndication manager, because that upside is 20%, not on capital that you invested, 20% that's just coming to you at the end of the deal if you performed well. If the deal's performed well, you paid them their money back, you crossed the hurdle, and now boom, you're getting 20% of the entire upside, right? So in a deal that goes well, this is a very lucrative position to be in, and that's why it pays well to be a fund manager, right? The other thing that comes with that, of course, are fees, because you're not working for free the whole time as a general partner either, right? There are a number of different fees that you charge to the fund as that fund manager or the syndication manager, right? Chiefly, some of those common examples are the fund management or asset management fee, right? Which is usually anywhere from 1% to 2% of capital, or sometimes it's 1% to 2% of what we call assets under management, meaning the total value of the assets in the fund, right? And that's usually paid on an annual basis to you. The second type of fees are your property related fees. So asset acquisition, asset disposition, or construction supervision type fees. So when you buy the asset, when you sell the asset, or while you're handling the general operations and contracting work for the asset, right? You'll also, of course, have property management fees and property management companies who will handle and manage the property, and they're also going to get a fee, right? So coupled with your promote, or what we call the carried interest, that distribution that we talked about, that 20% plus ongoing fees that you're getting for the life of the fund. And this is why it pays to be a fund manager, assuming that you're able to do these things properly and you have the experience and the deal is going well and you are being paid the fees and you are being able to pay your investors and get all your returns submitted, right? So in a nutshell, that's what we're looking at when we talk about, what business type terms are, right? So that's the easy stuff. Now we get into the legal deal points, right? So what does this look like when we put pen to paper as a lawyer and we want to structure some of these things, right? So right here, this is the most typical diagram, what we call an org chart of a syndication deal, right? Right in the middle there, you have the big entity called the fund LLC, right? That's going to be your syndication. It's typically going to be an LLC. Sometimes it could be an LP, a limited partnership. That's going to be dependent on the circumstances, and that's something that you speak with your lawyer about. But always it's going to be an entity in the middle that is going to be the actual owner of the asset, right? So all of these investors that are at the bottom of the chart, none of them directly will ever own the asset. We form this entity, which is the fund. It's going to acquire the asset. On the left of the diagram is your GP, which is you, if you're the fund manager or the syndicator, right? We also make sure that you come in as the manager or the general partner under an entity, because you don't want to do that yourself, right? That is your fiduciary role. That is where all of your liability rests. And we want to make sure that you structure that also as a limited liability company about 99% of the time. That's going to be your GP entity, right? It's going to get all of those fees in exchange for all the services that it's giving to the fund. It can be made up of all your GP principals. So if you've got 3 or 4 different partners who you're coming together with to do the deal and you're all the GPs, we would bring you together as one entity, and that entity is going to be the general partner, right? So this is a traditional and typical way to structure a syndication. So if you'll notice on the bottom right are all your investors, right? They come in and directly invest into the deal as LPs or equity owners. So they're giving you investment in exchange for their returns, right? Now, foreign investors, right? So this is the piece that everyone wants to really hear about on this call, right? So now we change up the structure just slightly to incorporate foreign investors, or what we call non-US persons, into these kinds of deals, right? And the way you do that is something called a blocker entity or a blocker corporation. Basically, one of your investors here that's going to be on the bottom, they are not going to be directly an investor. We're going to form for them what we call a Delaware Blocker Corporation. It's a simple Delaware C Corporation. And that C Corporation is what all of your foreign investors invest in. And then that C Corporation is the LP directly into the fund. So basically, we're just putting in another piece in the middle between the fund and the foreign investors. And that piece in the middle is usually a Delaware C Corporation, and we call it a blocker entity. So why do we do it that way? And what is a blocker entity? Well, it's because of tax, right? All of this is about, again, like I said, it's about making money, right? It's about those economics. So the reason you do this is primarily for tax benefits, because the United States and most countries around the world, we have what we call tax treaties with most of these countries, right? And the tax treaties provide for certain types of tax treatment based on the type of business that you're doing within the United States. So generally speaking, non-US persons are not going to owe taxes in the United States, except in limited circumstances. And this is one of those limited circumstances, right? So your fund or your syndication, we talked about this thing in the middle here, this the big thing in the middle, it's going to be either a limited liability company or it's going to be a limited partnership. But in either case, it's going to be taxed as a partnership. That means it's going to issue K1s, which are Schedule K1s, to all of its investors, and the income will pass directly through it. What that means is that all the money that this fund LLC makes itself, it doesn't pay taxes. It just reports the income, passes through all the income to the investors, and each of you investors pay your own taxes on the profits you make. Now, for foreign investors, the problem with that is a K1 pass-through income qualifies under the US tax code as being, quote, effectively connected with a US trade or US business. What that means is a non-US person is going to be taxed on that income, right? So you want to avoid that if you're a foreign person. Why would you want to pay taxes in the US if you're not subject to taxation in the United States and you're a foreign investor, right? So to do that, you don't want to hold a direct equity interest in that partnership entity. So again, enter the blocker corporation, where now as a non-US person, you are not an equity holder of the fund directly. You are an equity holder of this Delaware C Corporation, which is taxed on its own, is not a pass-through entity. That entity is directly an equity holder in the fund, right? So that entity will pay its own taxes, and you, the foreign investor, don't get taxed on the dividends that you make from the passive investment you have in a Delaware C Corporation. So it sounds a little bit like magic, but honestly, it's super simple. It's setting up a blocker entity that blocks the taxable income coming in from the fund and allows a non-US person to not be taxed on the dividends that they do receive on that, right? Now, I should be clear about a couple of things here, most importantly, right? Number one, again, as this has been disclaimed a few times, I am not a CPA. I am not a tax advisor. There are a number of limited circumstances in which this kind of a strategy might not work for you in your particular situation, in your particular case. So it's very important that you do consult with your CPA before you go ahead and structure blocker entities for these kinds of situations. The other thing to mention is that in many situations, when the fund itself, when the actual project is over and the fund liquidates, the blocker entity is a C Corp, which means it is subject to its own taxation. So A, there will still be a tax on the blocker entity for its own items. It's the dividends that it turns around and pays that might not be taxed. But it means that once you sell that stock or once that entity needs to be wound down, there may also be a tax liability on that, right? So again, there are a lot of moving pieces to a blocker entity. While what I'm sharing with you today is the very basics of the legal structuring of it, there are a lot of nuances with respect to the taxation and the tax structure of the blocker entity. And you want to be sure that you have a CPA looking at that very closely before you go ahead and enter into it, right? So I know I've been moving very fast through that slide, and I see a couple of questions come in. We're going to certainly get to that and come in and talk about this much more in depth as soon as we wrap up a few more slides here. There are a couple of other considerations for foreign investors, right? The first is called the FIRPTA, or the U.S. Foreign Investors and Real Property Tax Act. It's another law that does apply and govern non-U.S. persons investing into real property in the United States. So this is more applicable to the general partner, the syndicator who's putting the deal together, right? If you have non-U.S. persons in your fund, you are required to withhold the earnings, the taxable income from those people. Even if, you know, they're going to set up blocker entities or whatever the situation is, you are still responsible to withhold those taxes and make sure that they still do get paid to the US government. The US government will not leave you alone from your taxes, believe me, okay? If they don't pay their taxes, you will be liable, the syndication will be liable to pay those taxes on their behalf. So there are a lot of things that you have to do properly as a syndicator to make sure on the operations side that you're properly managing and operating the fund with respect to foreign investors that you have in the fund, right? Couple of other considerations, right? You as a non-US person, you might still owe taxes in your home country from the business that you do here, right? That's dependent on the tax laws and where you're from. So if you're from India or you're from Mexico or you're from Saudi Arabia, you need to consult with your own CPAs and your own tax advisors in those home countries because you might have taxable consequences there from the business that you do overseas, meaning in the United States, right? As a syndicator, if you're going to allow foreign investors into your deal, you have to have extra disclosures in the PPM that specifically talk about the risks for foreign investors that include all the things that we talked about today with respect to the withholdings, with respect to taxes and other kinds of things like that. So you want to make sure that you do have a good securities attorney who's drafting your documents with foreign investors in mind. And then the last thing that's super, super important is that the United States does have something called the US Patriot Act, which was passed after 9/11. And there are certain countries that we cannot accept investors from based on whatever list is on the no investment list based on the United States that is constantly being updated, right? You have a number of, anti-money laundering responsibilities to make sure that you're properly checking who your investors are before they enter into your fund, doing a number of customary checks to make sure that these people are not laundering money and giving it to you, things like that, right? So there are a number of things that do apply in this situation. And again, what you really need is someone who's well-versed in these topics, who can show you what it is you need to do, who can explain to you what you need to do. But on a high level basis, what you need to understand is that there are a number of things as a syndicator that you do need to be doing and taking extra steps for if you're going to allow non-US persons to invest into your fund. So long story short, that's really the outlook of how to bring a 30,000 feet overview really of how to bring non-US persons into your fund. There are a number of these additional considerations. There's structuring considerations, legal considerations, and tax considerations that you need to be very well versed for if you decide to go do some of these things. We can certainly continue on with some securities primers unless, Kavita, you want to stop here for a second. Otherwise, I got a couple of slides on securities compliance that I think are very critical for everybody, syndicators and LPs, to have a little bit of understanding in before we wrap up.
No, let's keep going. Thank you.
Yeah, all right. So the last piece that I really want to talk about today is securities compliance. Don't mess this up. I really have no better slide title for something like this than literally don't mess this up, because this is the area that's going to get you into the most trouble with the SEC if you do this wrong, which is the Securities and Exchange Commission, which governs the sale of private equity, which is what you're doing, by the way, when you raise private funds for an investment deal, right? So you have to be clear about what you're doing here. You need to have an expert securities attorney handle this for you when they structure your fund. You can't just put together an operating agreement, throw it together, have some people sign it and move on, right? There are a number of things that you have to be careful of on the securities compliance side, right? So this will take us all of maybe 3 minutes to get through. I'm just going to give you a super, super high level overview of these things. There are a number of nuances to this. There's a lot of detail that goes into this, all of which we're not going to cover here in the next couple of minutes. Very, very brief, just overview so that everyone understands sort of the breadth and depth of what we're talking about when we talk securities compliance, right? So what is a security, first of all, right? So when we say securities compliance or the sale of securities, what in the hell are we talking about, right? The SEC defines a security as anything. It's stock in a corporation. So if you own stock in Apple or Google or whatever, or any private company, a stock is a security, but so are limited liability company interests. So LLC interests, LP interests, any and all other equity securities of anything is considered a security and is therefore governed by the Securities and Exchange Commission, the SEC. There are two types of offerings. There's a public offering and a private offering. A public offering is exactly what you think. The stock is being sold on NASDAQ or it's being sold on some, the New York Stock Exchange or whatever it is. So it's a public stock like Apple and Google and all of those kinds of things. Everything else, which is 90% of everything else and everything we're talking about today, is a private offering, right? And if it is a private offering, it is subject to the SEC exemption rules, in particular, what most of you have probably heard of, Regulation D, right? Regulation D has two rules and you have to pick one. You have to pick what type of offering your deal is going to be. Is it going to be a 506B offering, or is it going to be a 506C offering? You have to pick one and you have to stick with it, right? Both of them, you can have an unlimited number of accredited investors, right? And by the way, an accredited investor, very broadly speaking, is somebody who has a net worth of over $1 million, excluding their primary residence, or they have $200,000 in income for the last 2 years, or $300,000 if they're joint married and filing jointly, right? Very broadly. And by the way, as it applies to foreign or non-US persons, accredited investor qualifications have nothing to do with residency. So this has nothing to do with whether you're a US person or not. You still have to meet these same exact criteria to be qualified as an accredited investor, right? So again, 506B and C both allow an unlimited number of accredited investors, but 506B allows you to take 35 non-accredited but sophisticated investors, and 506C only allows accredited investors. The offshoot to that is as follows, right? It's in the marketing. So 506B, which is the one that allows you to take 35 non-accredited investors, you are not allowed to generally advertise or solicit your offering. That means no social media posts, no crowdfunding, no general marketing or solicitation. You can only take into your offering and your fund people with whom you have a pre-existing relationship with. So family and friends that you've known before doing this deal. And if you do that, then you can take 35 non-accredited. Now, if you need to advertise, if you're putting up billboards and you're doing a social media campaign and you're trying to crowdfund from the public at large, that's great. You can do that as well. But then you're a 506C fund and you cannot take any non-accredited investors. You can only take accredited investors, and you have to take reasonable steps to verify whether that person is an accredited investor. And again, remember, this is what an accredited investor is, right? So if you're going to go and solicit and generally advertise on radio and TV or wherever and whatever, all the investors that you take in the fund must meet these thresholds for you to take them into the fund. A couple of other things that just to quickly blow past, but there's not just Regulation D that applies. Many experienced indicators forget even that you are still subject to 2 other securities acts. The first is the Investment Company Act, and the second is the Investment Advisors Act. Now, in generally speaking, in real estate funds, you're likely going to be exempt from both of these acts. All I want to say about this is please make sure you talk to your attorney and make sure you're exempt from both of these acts, because if you're not, then you're in violation of both of them, and we need to make sure you get that figured out immediately. But that's basically it. I mean, that's a super brief primer on securities law, and probably an even briefer primer on syndications in general and all of these kinds of things. So open to questions, happy to kind of jump right into that. Kavita, however you'd like to use it.
Thank you so much. That was very informative. I especially liked that little picture which showed the blocker entity and how you can get the investors.
Yeah.
So I think we can go through some questions now. I see a whole bunch of questions come in. I think we can skip back there. There might be a question. Okay, Kunal asked, for a blocker entity, why do you use a Delaware state and not another state like Wyoming or Nevada?
That's a great question. And you can certainly use any state you want. It doesn't have to be a Delaware entity. We picked Delaware for a couple of reasons. Number one, it is the most friendly from a legal perspective. So if you get sued for some reason, and that's not to say that it's necessarily going to hurt you if you're in another state, but Delaware law is very friendly towards businesses and business organizations. So there's a reason why most of your Fortune 500 companies are all organized in Delaware. It's because they want to be able to apply Delaware law should they ever get sued. And it's very favorable towards businesses, right? So in generally speaking, it's usually the best place to form it, especially if it's a multi-state type entity, right? Nobody's actually living in the United States for you guys, for foreign investors. So it's better to just have a Delaware entity where you get that maximum protection. The second reason is relatively the same, and it's from a tax perspective. Delaware law is usually very favorable to taxes as well. Because remember, in addition, in the United States, in addition to your federal taxes, which is what we've all been talking about, your entities are also subject to state franchise taxes, right? So each state that you're domiciled in will also require you to pay or report your franchise taxes, right? So Delaware is also usually favorable in that respect from taxes. But again, for both those considerations, you need to talk to your CPA as well to make sure that there is a reason why you want to be in Delaware versus another state that might be better for you.
Lisa asked, this is a question I had too. If a foreign investor can just create an entity that they can use to invest in US syndications.
Yeah, I mean, anybody can create an entity, right? So you do not have to be a US citizen to create and own a US entity. So today, even if you're not a US citizen or even a resident, you can certainly file for, create, and maintain a entity in the United States. So you can certainly file for it yourself, you can create it yourself, and you can own it and do whatever you need to do with it. But again, in the United States, based on the type of entity, based on its underlying tax structure, so for example, blocker corporations are C corporations, meaning they're taxed at the C corp level. You will need presence in the United States, like at least professionals like a CPA or an attorney or whatever it is to help you maintain, pay the taxes, and keep the things going for it.
So let me ask you one more question there, Adnan, just as a follow-up. So the blocker entity is typically maintained, like the C Corp will be maintained by the syndicator or the sponsor of the entity?
No.
No, okay.
So yeah, so who owns, and that's the other part of the question, I guess, who owns the blocker corporation? Not the fund manager. This entity belongs and is owned by the foreign investors, right? So let's say you have a group of 3 foreign investors coming from India that know each other. They get together, they form the blocker entity. That means all 3 of them are going to own that blocker entity 1/3, 1/3, 1/3, right? This blocker entity is not something that the syndicator is responsible for. That is their own, and just like any other investor that comes in, if they come in with their own entity or their own whatever, the blocker entity is simply just another LP entity that's coming in, right? So it is their own responsibility. Now, more often than not, yes, the fund manager, the syndicator, is going to assist the foreign investors in getting all of those things set up, right? They'll refer them to the attorneys. They'll sort of make sure that everything is structured properly. They'll do those things, but the entity itself belongs to and is owned by its investors.
Got you. And as a syndicator, would that be a good practice to have just one blocker entity and lump all your investors in that entity? Or would you create a blocker entity per country? Or I don't know, I'm just trying to wrap.
Yeah, that's a great question. And it's a case-by-case basis. As a syndicator, you want one entity only because your cap table is going to be so much easier to manage with just one entity and one K1, right? But there are obviously a number of reasons why you would have multiple blocker entities, right? If you have investors coming from different countries, you might need a blocker entity for each of the different countries because the tax laws in the home countries might be different. So each of the investors from the different countries might need their own blocker entity for their own tax considerations, right? There might also be a situation in which, contrary to what I just said in the previous question, the syndicator might in fact be the manager and fiduciary for the blocker entity because they just decided that they're taking that burden on themselves to do it to help the foreign investors, right? In that case, yeah, that they probably also want just one entity to manage or whatever the situation is, right? But long story short, that's totally a case-by-case basis. And from a syndicator's perspective, you want to kind of minimize the number of entities you have, right? And from an investor's point of view, it might just vary depending on where you're coming from.
Makes sense. Right. Can you please talk through a case study or example comparing foreign investor coming in directly versus blocker entity? Some representative numbers will be helpful. I'm not sure about the numbers, but maybe you want to take this. I don't think they can invest without a blocker entity, right?
So they can, right? So it's not that you necessarily can invest via a blocker entity. First of all, I apologize. I definitely don't have numbers or a case study like that to just kind of jump into, right? Just off the top of my head, because again, the main takeaway that I want most people to take from this is the use of blocker entities is a tax consideration, right? These things are, I'm showing you how they're structured legally because I'm a lawyer and that's how we structure these things from a legal perspective. But the reasons why you structure this and the reason that you have to do this is all tax, right? So the reason you're doing the blocker entity is to save on those taxes, to avoid having allocation of taxes to foreign non-US investors who would otherwise not be subject to those taxes in the United States, right? So if you're coming in without a blocker entity, that's fine. Understand that if you are, you know, part of one of those countries that is going to be therefore making you subject to the tax, if you invest directly without a blocker entity, all the profits that you're getting from this investment deal, you are going to be subject to those taxes in the United States. So if you're a non-US person and generally you don't pay US taxes, you will now have to pay those taxes if you're not coming in via a blocker entity. So again, it's a tax consideration, it's a tax reason for doing so, and that's why you really want to consult with your CPA because your case might be different from the other guy's case or from the other person's case and so on and so forth, right?
Makes sense. All right. How are the gains from the blocker C Corp passed on to the foreign investors? Will that be dividends only?
Great question. So typically, yes, right? So that's the whole reason for the C Corp, right? So the C Corp, when it turns around and pays its investors, it can do so in a couple of ways, right? The most prominent of which is issuing a dividend, right? So yes, a dividend is exactly the purpose for the C Corp, because the dividend then is not subject to the U.S. tax when it's paid out to the foreign investor. Now, as I mentioned, there are a couple of other things to keep in mind in this situation, excuse me, and that is really the value of the stock, that you have in the C corporation, right? If that is ever sold, or if that ever increased value and you need to get rid of that, that is going to be a taxable event no matter what you do, right? Because now you're selling stock in the United States. But being paid on the dividend, it's exactly how you distribute the profits from the blocker entity back to the foreign investors, correct?
Makes sense. Okay, this is a good question. Is there a general rule of thumb for fund managers where there should be a minimum number of foreign investors before the blocker entity makes sense from a cost and management resource perspective?
Yeah, absolutely, right. And look, this is absolutely with no prejudice to non-U.S. persons investing in the deal, but the truth of the matter is your costs go up as a syndicator if you're bringing in non-U.S. persons, right? Especially if you're assuming the responsibility of the blocker entity. Like I mentioned, more often than not, the blocker entity is really their responsibility, the foreign investors. If they want to invest in my deal, I'm going to assume they're talking to their attorney and their CPA, and they're setting up a blocker entity for themselves to come into my deal, right? But if I am that nice kind of syndicator and I'm going to handle that for you because you're my investor, I'm managing that relationship and I'm helping you get into this deal, then yeah, I'm assuming the cost of setting up the C Corp, I'm assuming the cost of maintenance and ongoing operations of that C Corp, right? So at a certain point, I have to ask myself what the numbers look like, right? What is it going to cost from a legal perspective or a CPA perspective to open, maintain, and manage this blocker entity? And is the investment that I'm getting from these investors, A, covering that cost, but B, making it worth it to where it's worth doing that and still being able to get their investor? Because if I can just go out there and find another 3 or 4 investors in the United States to make up that difference, then I'd probably rather not take the foreign investor, right? Because the cost is going to be a little bit higher. I don't think it's going to be generally prohibitively higher, so I don't think it's something that you need to worry too much about, right? Like, for example, the cost of setting up a Delaware C Corp is, a couple of $100s, right? It's not that egregious from the filing fees, right? What are your legal fees there? Well, I can't exactly speak to that off the top of my head. That's every lawyer is going to quote you something differently based on what it takes to set something like that up, right? But then you do have CPA fees. Maybe it's going to cost you $200 to $500 a year for your CPA to prepare the tax returns and to issue, the dividends, or to issue stock certificates, or whatever it needs to be that needs to be done on that side of things, right? So yes, there are a number of budgeting and cost requirements that you should really consider, and then weigh that against what the total amount of investment is coming in, and make a decision if it's worth it to pursue the foreign investor versus just go after more U.S. investors.
Thank you for that. That makes a lot of sense. Kunal says, can a foreign investor become a shareholder in the blocker C Corp using an ITIN? Or what is the pathway to becoming a shareholder in the blocker C Corp?
Yeah, so being a shareholder of the blocker C Corp is just like anything else, right? They're issued stock certificates. And again, you don't need to be a US resident or citizen to be that. You most likely do need like the TIN, right? The ITIN, which is just your identification number for purposes of the IRS to be able to identify you as a shareholder. But that's it. I mean, it's like owning Google or Apple stock, right? Today, you can go onto any platform and buy a share of that company or whatever it is, so long as you put forth the investment dollars and they issue you the stock certificate, right? So the exact same thing is happening here on a private basis, where the blocker C Corp will issue you, a stock certificate for X number of shares in that entity in exchange for your investment directly into it.
Got it. Can you please speak to how a foreign investor, for example, from India, can get accredited, that is SEC compliant? And that, I think
Sure.
Another question is also saying, how do you get accreditation for foreign investor?
Yeah, so accredited, becoming an accredited investor doesn't require, filling out any forms or anything like that necessarily. You either are an accredited investor or you're not. It's a threshold level for your income and your net worth. And there are no residency requirements in the definition of an accredited investor. You either have $1 million US in net worth, you have made $200,000 in US $200,000 in net income, regardless of where you live and regardless of who you are as a citizen, right? So if I'm a 506B offering, let's say my deal that I'm offering to people is a 506B offering, I can take an unlimited number of accredited investors, but I can only take 35 non-accredited investors, provided they are what we call sophisticated investors. And I can touch on that in a little bit. But basically, there's going to be there's a form that's part of the subscription packet that most lawyers prepare for every deal. It's called the Investor Suitability Questionnaire. There's a little checkbox that says, hey, do you have, $1 million in net worth? You can check yes or no. Do you have $200,000 in the last 2 years in annual income? You check yes or no, right? And that's it. So as a fund manager, I need to look at that checkbox that you filled out and rely on it because you're telling me you're an accredited investor because you have that number of money, right? And for a 506B, that's good enough. I can rely on the statements that you present to me and tell me that you're an accredited investor. In a 506C, remember that you can't do that. In a 506C, you have to verify that for me. So I'm going to need a signed letter from your CPA or from your attorney that tells me that they have looked at your tax returns, or they have looked and they have knowledge of your net worth and you're accredited, right? So again, to answer the question, generally and broadly speaking, it's not like you have to apply to the SEC to be an accredited investor or anything like that. It's just a matter of threshold for who you are as a person. Do you qualify at this level or do you not, right? And that's it.
So Adnan, as a follow-up to that, if I'm a syndicator and I want to bring in a foreign investor, I can rely on that particular CPA or the tax professional there or an attorney there to give me a letter saying that this person is accredited by US standards.
So two things about that. Generally speaking, yes. And when you talk about that, you're specifically talking about a 506C, right? In a 506C, you have to go that extra step and do the verification. And the rule there is you have to, quote, take reasonable steps to verify the accreditation status of an investor. Now, there are two ways that you can really do that. Number one, you can ask them to send you their tax returns, and you can personally look at their tax returns and say, yes, I've looked at it, and you are in fact an accredited investor. Congratulations. The other way to do that, though, what is accepted by the SEC is what most people do 99% of the time, is you can have your lawyer or you can have your CPA, somebody who does have intimate knowledge of it and is willing to certify on your behalf that you're an accredited investor. They can submit a letter to you, the syndicator, and then you can rely on that letter, that certified letter, as taking reasonable steps to verify that, correct?
So
in a 506.
I think my question is, I've done the 506C and that letter came from that particular person, in this case, a US investor's CPA or attorney. But in the foreign case, my question is, can that be submitted by the foreign national, like the foreign CPA or attorney, not the US one?
Yeah,
okay.
yeah. So in most cases, provided that we can rely on that. Now, what I will say about that, we still recommend all of our clients when they are getting verification from non-US persons to see if they can utilize a United States-based lawyer or United States CPA to give us that, because we just want to make sure that the same qualifications for the licensure for that recommendation are in place, right? That is a case-by-case basis, I would say, and that's something we can certainly talk about more in depth offline if anybody has questions about it.
Got it. Okay, let's see. If I were to set up a local US LLC, is there an option different than the blocker corp? I think this is a foreign investor asking, like, I think his question is, if I just want to set up an LLC, can I do anything differently other than just using the blocker corp?
So the reason the blocker has to be a C corp is because, again, the whole purpose of using a C corp is to get you out of this requirement, right? Is that if you invest in a pass-through vehicle, the business and the profits that are coming in are effectively connected with US trade or business, right? That's the problem with a partnership pass-through vehicle. So as a foreign investor, the reason why blocker entities usually need to be C corps, now they can, there's special circumstances for everything, right? But the reason that most of the time they need to be C corps is so that you're getting out of that requirement to be taxed because something is effectively connected with the US trade or business. The stock you hold and the dividend you're being paid on that stock is what we call truly passive income, and therefore you're not going to have the same tax liabilities on that, right? A pass-through taxation situation, you will be effectively connected to US trade or business and therefore have taxes on it. Now, again, the blocker entity itself can be directly invested in an LLC, right? Which is what you would set up for the syndication, right? 90% of the time, it's going to be an LLC that's in the middle, right? That is going to be a US LLC. It's going to be, whatever state the deal is happening in, or it's going to be a Delaware LLC. The blocker entity will just be an LP or a member investor directly into it. Does that answer the question? I hope that answered the question.
Let us know if it did. Okay, this is an interesting one. I think we should take this one. What type of write-offs can a foreign investor take against the blocker for? Also, can they leverage cost segregation?
That is a great question. Unfortunately, that is absolutely a CPA question. That is not something that I can absolutely answer with any real definitiveness. And I'm a little weary to give an answer on that because really what a write-off is and what is not, I'm going to leave to an expert on the US tax code. And usually that's CPAs or other tax professionals. Really sorry, but if you want to send me that question or connect with me offline, I'm happy to get you to somebody that can answer that more confidently than I can.
Maybe we should get a webinar on blocker entities, how to manage them from a CPA perspective.
Yeah, I think a CPA would be great to kind of give a part two of this kind of stuff. Because again, like I said, as much as I'm happy to talk about the legal structuring of these things, the use of a blocker entity is so tied to tax reasons and tax consequences and taxation in general, right? So really what you need is a CPA to kind of give you more 411 on the tax implications that come with something like this.
Okay. Again, lots of tax questions here, so I think we might have to skip over that. But generally, do you know if the dividends are subject to tax withholding? Is that
generally speaking? No. Well, they are, right? So that's capital gains tax, right? So that's why you do it, because it's not that you're completely free of those things, right? But you're going to be in a significantly lower tax bracket if you are taxed at all. There are a number of treaty countries with the United States, right? What we call tax treaty countries, in which you're not subject to tax at all, right? And it depends on the country that you're coming from. And I don't know that list off the top of my head before somebody asks. But if you are subject to it, which again should be in a limited circumstance, then at least you're subject to the capital gains tax rate, which is only about 23%, as opposed to the 30-40% that you would be taxed on investing without the blocker entity.
Got it. Trying to see any other questions. Do you set up one blocker entity for each deal, or can you just set up one blocker entity and use it for multiple deals?
So you typically want to set it up for each individual deal, but if it's the same exact investors and there are really a group that's doing US investments, then I think it's okay to use the same blocker entity for multiple deals. I think it's a case-by-case basis. I think there's other considerations you want to take into account that are non-tax, that are in fact legal. So for example, liability exposure of the different assets that you have. If you want to separate them, then recommend different entities. If it's just passive investments purely, then maybe the risk is not so high, right? So there's a number of legal considerations as well. But I think that it can certainly be done that way if the answers kind of come out proper in a situation like that.
I think there's some specific question for Canada. I don't know if we can answer any specific questions like that.
I wish I could. I'm not familiar with Canadian law. I am only a US attorney. So unfortunately, I don't know what the rules are for Canada. What I will say is, especially with respect to securities compliance, you'd be surprised how many countries have very similar securities compliance mechanisms and structures for business and corporate and securities. So again, I really can't speak to it. I don't know anything outside of the United States law, but I would have a feeling that at least it's fairly similar.
Okay, this is an interesting one. So when you have a 506B or a 506C structure, so let's say it's a 506B structure, the 35 sophisticated investors, can you treat the entire blocker entity as a sophisticated investor, assuming all the investors are sophisticated, or because it's coming in as one entity, or just each individual investor that applies?
Yeah, that's a great question. And we get this question a lot, right? Because, for example, under the Investment Company Act, which is one of those other securities acts I told you about, to remain exempt, you have to have fewer than 100 beneficial owners. So the count does have to intake some of those. But for purposes of Regulation D, no. The good news is with Regulation D, if your non-accredited investors are coming in, they count as one non-accredited investor. We don't have to do the look-through on them for Regulation D, but it's important to still keep the look-through in mind because, again, there are a number of other securities acts that do apply to you that do require the look-through. So for purposes of counting your non-accrediteds, that's fine. But for beneficial ownership, that is going to require a look-through.
And what do you mean by beneficial ownership? I'm not sure I understand.
Yeah, so beneficial ownership does mean like, okay, let's look through these entities and really determine the number of investors, the number of actual people that are part of this, right? There are a number of rules for that that are sort of nuanced and way too complicated to get into on this call. But what I'm specifically talking about is here, right? So the Investment Company Act. When we say a beneficial owner, what we mean is exactly that. Like on a look-through basis, there's an entity that has 5 investors in it. We need to count all 5 for purposes of this act, right? Especially if the entity was not formed, was formed specifically for this investment, right? So if it's a SPV that was formed expressly for this thing, then we do have to start looking through and doing all of those things.
Question, just as a follow on, if you have, let's say, a couple of accredited investors and then a couple of sophisticated investors in the blocker entity, now what is that? What kind of an investor does that entity become?
Yeah, that's certainly going to be not accredited then, right? So the way an entity typically qualifies as accredited, there's a whole list of ways that entities, but the most common is that all of the beneficial owners of that entity must also themselves be accredited. So if you have a 506c offering and you're getting a blocker entity, everyone in that blocker entity must also be accredited. That is on a look-through basis, right? So for accredited investors in a 506c round, we are going to need to know and make sure that all the people invested in it are in fact accredited investors.
Makes sense. I think we got a lot of questions answered with that. Do we need at least one US citizen as a member of the blocker entity? I don't think so, right?
No.
All right, this one's an interesting one, but I don't know if it matters. Could the blocker entity be set up as a loan? So paying interest first, then loan, and then equity?
That's a great question. So yes, in the sense that, I mean, the blocker entity then is not an investor, right? There's a difference between an investment and a loan, right? Generally speaking, an investment, you're giving investment, and sure, you're getting the preferred return, which is like interest, but it's not, right? You could lose all your money today and there's nothing to do about it. A loan is a secured obligation, right? It is a debt that has to be paid back. So first, it's going to get paid before investors get paid because it is a debt on the company, just like the lender, right? So if the lender in a deal is providing a loan, that's a loan, right? So that has to get paid back first. That lender is not an equity holder in the fund, right? So it's going to it's basically it's doing business in the lending business. So whatever the tax rules are going to be with respect to the income that you get as interest income, I can't speak to that because, again, I'm not a CPA. So if those taxable returns are going to be different for you from an investment, which they are, then you need to see if that's a better route for you. But again, the fund itself, if I'm a syndicator, I'm not looking to take a loan. I'm looking to take investments from investors, right? So I'm probably not going to want to take a secondary loan, especially if I'm getting one from a lender, generally speaking, for the property.
Yeah, and I think that's also an issue because lenders usually object to having a second loan also. The primary lender is not going to be super happy with you having a second lien on the property.
Right, and there's usually not even likely going to be, there's usually not going to be security for the secondary loan either, right? It's not like they're going to have a second security interest in the property, or if they do, it's not really going to be worth a whole lot, right?
Right. And you could set them as like a preferred equity partner where you give them like a flat 10 to 12% return and not give them an equity share, like a back end. But I think in that case, they would still work just like an equity partner for all practical purposes, except that they don't get the equity in the property.
Right. I mean, that effectively what you're talking about is what we call like a profits interest sharing agreement, right? Where you're getting some percentage of the profits that come in or whatever the situation is, right? But again, even there, you need to be careful of your tax consequences, right? How you're earning that is going to affect in large part the taxes that you pay or you don't pay, especially as a non-US person.
Okay, a few more questions, I think, here in the chat box that I might have missed. Does FIRPTA apply to any dollar value? Is there limits from which FIRPTA applies?
I'm not sure I understand the question. Limits in what sense? Because what FIRPTA requires is that you need to just withhold whatever the tax are going to be. So if for example, if there's $100,000 distribution being made to the investor, whatever the tax consequences are likely to be, we need to be withholding that, right? As a syndicator, and your CPA is going to know how to do that. So I'm not sure I understand the question, but no, generally speaking, I guess the way to answer that is there's no limits on that, right? So whatever the distribution is going to be, you're liable to withhold those taxes for a foreign investor.
I think his question is more from a dollar perspective, meaning that, let's say if it's less than $5,000, whatever the number is, you don't have to withhold. And if it's more,
no, there's no, not as far as I'm concerned. Again, I could be wrong on this. I'm just going to be fully honest with you. This is certainly something I need to have my partner Matt take a look at, or a CPA take a look at. But from as far as I'm concerned, no, there's not a dollar limit. You do have to make, you do have to do all of your withholdings.
Okay. Two more questions and then we wrap it up tonight. Is the word blocker a legal term? Are you using this term to simplify the illustration?
It is a term of art in the legal industry, so it is absolutely recognized and considered. It's not a legal term per se. It is a term that everybody uses. It's even in all our legal documents, and it's recognized exactly for what it is.
Right. The last question is, can a blocker C Corp used for a joint venture, keeping in mind that in a JV, the C Corp will be considered as active and not really passive?
Yeah, so I wouldn't recommend that, right? So let's take a look at this chart really quickly again, right? So if we're looking at, here we go. If we're looking at the, whoops, what just happened? Went too far. So if we're looking at this chart again, right, this is the general deal. Now think of this as a JV instead. So the only difference in a JV is you're likely only to have like two of the manager entities coming together as a joint session, right? As opposed to all the investors at the bottom, right? Now, the same exact tax considerations are going to apply. That blocker entity is still, the purpose of a blocker is to get between the active investment and the investors, right? So especially in a JV situation where there's activity going on in that level, you want to have that blocker entity, right? You don't want to have a C Corp where like right in front of the asset either, because then you're having double taxation right at the bottom level, right? And that could also be a problem for you. So typically I wouldn't recommend that. Again, with respect to whether or not the active C Corp should be in front of the asset, that's going to be a CPA question for sure, because you're going to be subject to a number of different taxes as a C Corp than as a pass-through entity, right? But I don't think that you would typically want that right in front of the asset.
Okay. I think with that, we conclude today's webinar. Again, thank you so much, Adnan, for being here tonight and sharing all this information. I know I learned something here, and I hope all you guys, whether you're investors or syndicators, learned something today about how foreign investors can come into US real estate and other investments as well. This is definitely not limited to real estate, but any kind of private offering, as Adnan pointed out. Again, thank you, Adnan, for being here tonight and taking time away from your family and hanging out with us tonight.
Absolutely. It was a real pleasure. Like I said, I am very nerdy about this. I love talking about this. If we didn't get a chance to answer your question, I'm more than happy to talk offline. My information's on the screen, and I'm sure you can get it from Kavitha as well. If anyone has questions, don't hesitate to send me an email. More than happy to see if we can assist in any way. And again, thank you so much to Kavitha and to Cherry Street for having us on tonight. It's been an absolute pleasure. Thanks very much.
Thank you, Adnan. And thanks everyone for joining in tonight. I always appreciate you taking time away from your families to be here and learn with us. Hi, I'm Kavitha Bartake. I hope you found this video useful. And if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.